Good morning, Daniel.
Morning, Ben.
What are we chatting about this week?
Well, you recently came out with a book, I believe, and I read it, and I figured there were some points and ideas from the book, without spoiling it for the audience, that we could pull into today's conversation.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, I'll say book and read are two generous words for the content of that, but as you said, we'll avoid spoilers. So, what in particular do we want to talk about in it? There's 50 chapters of stuff in there, so there's a lot we can talk about.
Yep, I did not want to discuss each and every chapter. I think I pulled three or four that kind of stood out to me today, and figured we'd just discuss them. So this is really in no particular order. But one of the things I thought was interesting on the investment side, as you said, and I believe it's a quote, so it's not you saying it, more you paraphrasing or including the quote. But he said technical analysis is astrology for men.
Yeah, chapter 19, I believe. Technical analysis, for anybody who's not familiar with that term, essentially there are two core types of analysis in investing. Fundamental analysis and technical analysis. Fundamental analysis is where you look at a company, you look at its balance sheet, its cash flows, its P&L, its management. Like you look at what the company is made out of or what the investment is made out of. You assess and analyze its qualities, and use that to determine whether you think it's fairly priced, underpriced, overpriced, and those create signals for whether you should or shouldn't buy it. And that's what most mutual funds, most investment companies, most hedge funds are doing all the time. Then there's technical analysis. And technical analysis says we could be talking about the value of carrots for all it matters. We're just going to look at the charts. We're going to look at the fancy candlestick charts, the line charts. We're going to use trends. And quite literally, we're getting into sort of like the tea leaf reading era of like, well, if the line wiggles in a certain way, it means this. And if the line goes up and then comes down, but then goes up a little bit more, but then comes back down and then goes up again, like there's certain triggers here where we're supposed to see trends. And in a weird way, there can be a self-fulfilling prophecy thing about it. Like if 100% of investors were doing this, then these would become self-fulfilling prophecies because everybody would do the same things with the same signals. But generally speaking, right, it's sort of this tea leaf reading activity.
And I assume this tea leaf reading activity is done in the short term. Like these aren't looking at charts and things over the course of 6 months, a year, 5 years. These are like decisions made on a daily basis.
Pretty much on a daily basis. Like there's some technical analysis you can do over longer terms. You get into terms like resistance levels. It's not going up above a certain point, or it's not going below a certain point. Resistance support. There's all these terms for it, but I mean, effectively, you can go and find like TikTok videos of people sitting and they're literally just like staring at a screen, watching the price of something like bounce up and down, and they're moving these like auto triggered buy, auto triggered sell lines up and down around it. And it's almost like a video game. Like they're really just like trying to kind of follow the line in such a way that they're only buying it and only selling it when it hits these certain levels, and they're trying to move the levels around to capture more value and so on. It's very gamified. It looks great on television and in movies, but in practice, there's essentially no empirical evidence for it that is reliable or valid. And reliable and valid are academic terms of research. Reliable meaning it happens consistently, and valid meaning that it's actually true or actually correct. And so with both of those problems, there's a mountain of anecdotal evidence for people like, oh, I did technical analysis and I bought the thing at the time, and then I saw the right wiggle and I sold the thing at the time, and it went the way it was supposed to, and so it must work. And then there's an enormous amount of unspoken, anecdotal evidence from people who, did the thing and then the line went the other direction because something else happened in the world that was not captured by the lines. And so that's where, again, technical analysis is astrology for men. It's reading signs in data, looking for meaning where there is no meaning.
Yeah, I think I had a buddy or two that did like what is it, forex, like trading, like
oh God, help them
in high school, and they tried to pitch me on it when I was in college before I started doing this as a career, and it's interesting. Like I think it's one of those things. Like, can you make money in the very short term doing it? Sure, but none of them are doing it anymore, right? And I think it's extremely difficult in the long term to probably continuously make money on something like that. in a way that satisfies your needs and goals and objectives without, um, going broke.
Well, and it comes around to the classic market analogy of picking up pennies in front of a steamroller. Like you sometimes the strategies or the assets you're trading on, because the trick is you can do technical analysis on pretty much anything. Part of the problem that sometimes arises here is that like you're making you're making 5% in a day, awesome. You're making 10% in a day, awesome. Like those are great results, but often you're doing it at the risk of going to zero, right? But when I buy like Apple stock or I buy an S&P 500 index fund, I've got a pretty high confidence level that Apple's not going to go to zero overnight. It could. Apple as a company, any company can fail, right? But if I buy the S&P 500 through an index fund, I own 500 companies. I'm pretty confident that the 500 largest companies in America are not going to go to zero overnight. And so there's just a fundamental difference in buying assets for the value of the assets to be an owner of their profits or to share in the appreciation of the value of the enterprise versus just jumping in and out of anything just because you think the line is going to wiggle the right way.
This is more of a technical question for my curiosity, but like, are people doing these in taxable accounts where they're just generating, these small incremental short gains and losses, or do they tend to do them in, qualified accounts where maybe they're not paying taxes every year?
Some are doing them in qualified, some are doing it non-qualified, and a lot of this comes back to like, where is your money in the first place? Like when you get into technical analysis, a lot of people are doing it with money they already had invested, and they might have already had it in a 401k or a Roth or something like that. But plenty of other people are just putting their $1,000 they had in their savings on a Robinhood account or something like that, and then are just sort of jumping in. There is such a thing as having day trader designation for tax purposes, where essentially if you have, in the same way that there's like real estate professionals, if you do enough day trading over enough days of the year, enough transactions, etc., all the capital gain stuff just sort of gets washed out, and essentially you just get to use your aggregate profit for the year as your taxable income or as your aggregate loss, as the case may be. You have to trade a lot to trigger that eligibility, and frankly, it simplifies a lot of things for you because essentially your tax return just goes from a million long-term, short-term capital gains and losses into just where'd you start, where'd you end. The number in between is your income. But at the same time, right to your question, there's a lot of tax advantages to having a longer term disposition in non-retirement accounts. And so it's something that I think day traders actually can lose out on. Hopefully they're making a ton of money taking big risks and they're not getting crushed by the steamroller, but plenty of people do.
So what you had mentioned fundamental analysis in this book as well, but like on the surface level, especially when comparing it to technical analysis, sounds a lot more reasonable, right? You say we're looking at the intrinsic value of companies, analyzing the balance sheet, profit and loss, probably the business model and how they function within the business they operate in, and then making investment decisions based off some of those metrics. Is there anything wrong with that? Is that what we're using here, or is am I off base there?
We're sort of using a zoomed out version of fundamental analysis because we don't get to the securities level. Like we are not in the business of analyzing Microsoft stock or Apple stock and recognizing whether it's underpriced or overpriced. All the major investment funds and firms out there are doing that every day anyway, so we don't need to replicate that or do that work by hand. When we look at it, we're looking at more the quality of the funds or the indexes that we're selecting from. Right? Is this a high quality S&P 500 fund? Is this a high quality total market fund, a high quality international fund, and so on? And we're comparing these professionally managed funds to each other and assessing which one we think is the best fit for our clients. There's sort of a two things true at once thing in fundamental analysis. Right. If I ever went to an investment fund that was actively managed, right, where they're actually like picking and choosing versus just aggregating the index and trying to mirror the index, and they came in and said like, well, we didn't really look under the hood at what this company did before we bought it, I'd be like, you're idiots. Like, what are you doing? Why are you throwing client money at things you don't understand? On the other hand, you have some dumb phenomenons under fundamental analysis. The one I always like to look at is Tesla. Like Tesla is the most absurd, like from a fundamental analysis standpoint, is the most absurdly overpriced asset in the world. Like it's like 300 times earnings or something like that. And it has gone up and people have made money on it. And it's just because enough people have piled into the Tesla kind of legend, myth, whatever we want to call it, and they want to own it early because they think it's going to be the next great company. And that's when we're under fundamental analysis. Sometimes, the fundamentals don't make sense and yet you can make money on certain assets because there's such a zeitgeist for that thing. Same thing for like the GameStop, hysteria, or AMC, hysteria. There was not a good fundamental case to buy GameStop or AMC at the time, but just enough people went crazy for it and made money on it because everybody kind of went crazy for it. And then lo and behold, time passes and it's kind of crashed back down to where it was. So there's pros and cons of fundamental analysis. It's not to say that it's perfect, but if you tell me I want to pick investments based on the characteristics of the company and its profitability and its management and so on, versus I want to buy this stock because the line wiggles the right way, I'll take the research analysis on the company.
So is this the same as like value investing, where you're like, okay, I think this thing is worth 10, but it's trading for 8, I should buy because I think it's worth more and will go up in the future?
We're conflating value investing with just price discovery here. So I want to separate what you just described a little bit. Value investing is picking companies that we think are strong, sustainable companies that pay dividends, that are sort of in the way that if somebody came to you and said, like, do you want to buy my restaurant? You'd be like, well, how much revenue do you make, right? Well, how much profit is there? And like, you would compare some of these data points to the price they're asking for and assess whether you think it's undervalued or overvalued. That's value investing. In the sense then that, if I know that a stock objectively is worth 15 and it's trading for 10, yeah, buy it. The only trick there is that you're still relying on the premise then that the market at some point is going to figure that out too and is going to buy it up until its price is up to 15. Sometimes the market ignores opportunities. There is such a thing as the efficient market hypothesis, which just sort of posits that all information is essentially already baked into the price of all assets. I think we can logically recognize that is not always going to be true, that there are inefficiencies. I think the challenge is for any individual investor is you are competing against hedge funds, giant mutual fund companies, right? Armies of CFAs and people with PhDs in finance trying to find, discovery opportunities. And every once in a while you do hear about it, but most of the time you are going to be far behind the curve. And most of the time when clients or people come and talk to us like, oh, what about this? What about gold? What about NVIDIA? They're doing it because the opportunity already happened. And now they're asking because they're like, well, maybe there's still some opportunity here. Sometimes there is, sometimes there isn't. But I've never once had somebody come to me and be like, hey, this tiny company you've never heard of, it seems underpriced. Do you think we should buy it? It's never happened. Everybody always comes to me after the thing is the biggest returning stock or thing of the year.
Got it. So you're saying we do more of a zoomed out fundamental analysis, like where we are looking at the reputability of investment companies or certain items or products, but not on the granular level of like specific companies and whatnot, looking at their balance sheets and profits and whatnot.
Correct. But we're looking at, for example, the underlying holdings of funds. For example, there's a thing called closet indexing. There are lots of super duper cheap index funds out there at 2 basis points, 3 basis points, 4 basis points. So costing you, 2 cents per $100 you invest a year type of cheap. And then there are actively managed funds that are costing, 50 basis points, 70 basis points, costing you 50 cents, 70 cents on the $100 a year that you invest. And you look at their holdings and they're identical, right? But one is charging, 20 times more because they have enough customers or clients who sort of have fallen for the sales pitch that they are really great at stock picking, but all they're doing is buying the index.
So you mentioned buying a restaurant as an example, right? And how you look at the profitability and revenue and whatnot. And in the book, you also talk about niche investment strategies, right? So one of them being investing in small businesses. It made its way into the book, so it must be a secret of the rich. Am I on track here?
There was this kind of book paper. It's kind of, I really don't like Harvard Business Review publications because they're often just like academic journals smashed into a book format. But there was this thing that came out a couple years ago, and it was essentially like a guide to buying small businesses or something like that from the Harvard Business Review. And there's then been this big trend of like, and you can Google articles about this all over the place. But like Harvard MBAs aren't going into investment banking; they're buying HVAC companies. There's a lot of that stuff going on right now. And here's the trick: like we have clients who've done exactly that. They're doing fabulously well. It's terrific. There's also a lot of people who are just kind of doing this like overly simplified calculus and just being like, well, if private business is the highest risk reward asset, I shouldn't be investing in the market or commodities or Bitcoin. I should be buying private businesses. And they're doing that without the requisite knowledge or understanding of the business or the requisite skill set to run the business, and don't recognize that they are over concentrating both their investment portfolio and, in some cases, also their income in their investment portfolio in this business. And so you have this weird trend of like all these trades businesses getting bought up by private equity, by individual investors, etc. And again, some are running really well, some are not doing so great. And so to your question, is it a secret of the rich to buy a small business? Two things can be true at once. Something like 90% of people in the 1% of wealth in the United States are private business owners. And so there's something to be said for that, or they're partners in a private business of some sort. And at the same time, business fail rates are higher than just about anything else. And so, it is a high risk, high reward story. You're going to hear about the successes because you are their customers. You go to that sandwich shop, you get a plumber from that company and so on. But also small businesses fail all the time. And so is it a secret? Not really. Is it a way to make money? It can be. Is it a way to lose money? Absolutely. So it becomes a question of, is it the right risk reward approach for your necessary objectives?
It also seems like one of those things that, for middle-aged family with 2 kids that has a couple extra $1,000 every year coming in and saves it, it might not be the best thing. But maybe somebody who's like, look, I'm already comfortable, I have my retirement and all these various assets kind of set up and tucked away for longer term goals. Maybe if they want to take a little bit more of the speculative risk on some of these small businesses, whether it's becoming a partial owner in a laundromat, or like you said, right, buying an HVAC company, or even starting their own thing. Maybe at that point it makes a little bit more sense, or is a little bit more reasonable, just given they can assume or afford the loss, but maybe not everybody else can.
Well, and I think that's one of the crux issues here, right? Like here in Longmont, we have lots of beloved small business owners who've had a career, right, and got into their 30s, their 40s, their 50s, and decided they want to get out of the corporate world and they want to get into, owning a business, owning a company. They want to do it themselves. I think about folks like Dave Farrow at 303 Sign Company. I think about people like Corey Lorenz with 1-800-Plumber. I think about all these small businesses out here where they're making it work. And some are franchises and some are unique individual businesses. Like there's Fire and Ice Wellness that just opened up over in the mall here in Longmont recently. And, he had a career for 20 odd years working in energy. There's this interesting activity where to some extent, there's a push-pull where sometimes the TikTokification of finance has a lot of people who are in their early 20s just going out there like, if I'm ever going to take a risk, now's the time. But the risk reward between being 20 and having nothing to lose and being 45 and having a family and a life savings and whatnot has sort of this weird inverse relationship, where simultaneously you might say, I'm too old or my family's too dependent on me, I can't take these risks. But also you can afford that risk more than a young person with nothing to lose. And so there's just an interesting dynamic here where at the end of the day, it's a high risk, high reward activity. I don't know that it's right or wrong for anybody individually. What I will just say as a small business owner, as being a small business owner, is a lot harder than it looks.
So it's interesting, like we work with a lot of folks, on a broad spectrum of wealth, right? Those that are, I'd say, mass affluent, maybe those that are just what they'd consider getting by, right? I'm curious though, like in your experience, besides maybe, investing in small businesses or some other things, like what do you see as like things people look at as like a shiny object, an object that they're not pursuing right now, but frequently will say, hey, Dan, what do you think about me doing this thing?
I think the core answer to the question here is going to be, does it actually help you accomplish your objective? Right? And the question is, what is your objective? Financial planning sometimes gets pigeonholed into this conversation of, hey, more money good, less money bad. You just need to get your 2 million, 3 million, 5 million, whatever, and you can retire and you're golden. And simple enough, right? I think when people think about like, I want to start a business, should I start a business? What do you think? My core question as a financial planner is a lot more about what does this do for your lifestyle and your quality of life, not just from a financial standpoint, but do we hate our job? Are we just looking to get out of it? Could we be just as happy at a different software company than our current software company, or at a different school district instead of our current school district? Could we be happier, being more of a consultant than a person who's hands-on, a manager versus a subject matter expert? That's always the question I want to ask before somebody wants to get into this world, because there are plenty of ways to build wealth. If the objective is just to build wealth, I don't think a small business is the immediate, go-to answer for that. So when you say I want to be a small business owner, I want to get out of my job, I want independence, control, etc., I want to understand how this business is going to support other aspects of your life before we just look at it as a financial conversation.
I think that's good. All right, so maybe not a secret of the rich, but also like you said, what I think you said 90% of 1% of people that are considered wealthy in the country are small business owners.
Look at small business owners, partial small business owners. Some are inherited. Sometimes it's a mom and pop enterprise, etc. But I mean, there is a strong relationship. I think one of the core issues, and this is more of an income observation than a business observation, but many people out there look for jobs with stable salaries and benefits and little to no risk in their compensation. When I say risk, they're going for a job that pays, let's say, 100,000 a year versus a job that pays 70 and could pay as much as 150, but you got to hit your numbers, right? Whether you're in sales or metrics or whatever it is. And I think there's something to be said for saying, like, look, risk has a relationship with return. If you look for 100% stability, you're going to get what you get, right? And you can change jobs, go back to school, increase your human capital, improve your income. But ultimately, right, for people who are willing to take risk and then perform well within that risk arena, that is going to work out better for them in a wealth building sense. But there is no free lunch, right? We'll use financial planners as the example, right? The industry-wide survival rate is 30% for people in the financial planning space. And when you look at the variable comp-driven, 100% commission, entry-level sales roles, the 4-year survival rate is 12%. Right? It means 88 out of 100 people are not going to be in this business 3 or 4 years after they start. And so again, we talk about risk first, right? And there's a positive relationship with return, but risk is not just the risk of losing money, it's the risk of a variation from your intended outcome. And so two things true at once. People who take risks tend to build more wealth. Also, people who take risks are more likely to file bankruptcy, suffer from stress, go through divorce, all sorts of negative ramifications if it doesn't work well. I like your expression on this, right? You control what you can control. So within that sense, if you're going to take risks, the only thing you can control is the amount of sweat equity you put into it.
All right. So last kind of theme I wanted to touch on here was taxes. And one of the parts of the book you have is just deductions and write-offs, right? And I think this is an interesting one because this time of year we're reviewing a lot of clients either file tax returns or preliminary returns prior to filing. And every once in a while, we'll point out something that, I'd say is a stretch in terms of their ability to claim. And most of the time, I think it's ignorance as opposed to trying to get one over on the man. But in your experience, right, maybe talk about some of the deductions or things that you see kind of come up frequently, and it's like, maybe not, and some of, I guess, maybe the errors or that people come across here.
I think there's a couple gradients of tax deductions versus tax planning versus tax evasion. And when we talk about most financial planning, most tax planning is just going to come down to taking advantage of deliberately established tax shelters, putting money in your 401k, funding an HSA, using an FSA for dependent care to pay for child care, taking advantage of the capital gains rules to go ahead and reduce your taxable income or use losses to offset gains. Like, there's a lot of stuff that anybody can do. It's very run-of-the-mill. It's very simple. When you get into serious tax planning, this is a multi-year activity. So, for example, taking your small construction company, turning it into a C Corp, and starting to look at leveraging that structure as a way to take advantage of small business tax exemptions or qualified small business stock exemptions, which could save you, hundreds of thousands, millions of dollars in taxes potentially. But that's a thing that's going to take 5 years, 10 years, 15 years to pay out. And by the way, you still have to run the business well and make it grow effectively. So there's a lot of advanced stuff. You can also get into a lot of estate planning where there's a lot of substantial tax things, charitable planning, lots of substantial tax things. What I often see where people have a mismatch of expectations is getting into tax evasion, right? And tax evasion is different than tax avoidance. Tax avoidance is legally structuring your affairs to reduce the amount of tax you owe. Right? And again, that's deductions, that's credits, that's delaying income, that's doing all the things that you can reasonably do within the law. Tax evasion is essentially just some version of I want to lie, or I want to not pay taxes, or I want to not report income so I don't have to pay taxes. And that's where I think a lot of people get into trouble. There's little what I'll call like white lie stuff where it's like, oh, I'm going to pay my homeowner's insurance through my business because I work out of my home, or oh, I'm going to have a company cell phone plan, and by the way, I might just happen to have my spouse and my kids on it. Like there's little stuff like that where like if you got caught, you wouldn't be in big trouble. But there's this strange appetite out there for people to believe that there's just sort of a magic wand to avoid taxes, and this is where you get back into like the TikTokification problem.
Why do you think that is? Do you think it's like because we can't like see the IRS? Like it's not like somebody's knocking on our door and asking us, "Hey, you claimed this home office deduction. I want to see the office," and like actually looking for things. Do you think it's more just because like the correspondence is by letter? I don't actually speak with anybody for the most part, and more likely than not, for what it's worth, they're probably not gonna find it or audit me. So like it's not that big of a deal.
I think it's a strong relationship to the expression that a lie travels halfway around the world before the truth gets out of bed. I think it's something where essentially there's just this endless rumor mill, right? Like I've got a friend, and my friend over beers last week was telling me that he and his tax guy do something, 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 but they're saying it in general terms, and I would like to take advantage of the something, something, something. And the question for any tax professional or tax planner in that situation is going to be, are you eligible for the something, something, something? Maybe it's legitimate, maybe it's not, but sometimes people are just like, well, he doesn't pay anything in taxes, blah, blah, blah. I don't want to pay anything in taxes. Well, maybe that's because he's not making any money. Or maybe that's because all of his, he had the savings to live on and he's delaying income through portfolio assets, or he's taking advantage of tax deductions through accelerated depreciation on his business or on his real estate. There's all sorts of stuff out there, but there's this appetite for people to just do something, and I like to call it the whiteboard lie, which is you get these videos of people and they're like, well, you have a house, and then like you're going to put your house in a trust, and then you're going to rent the house back to your business, and your business is going to be paying money into the trust, which is then going to not pay taxes for some reason that's made up, and then at the end of the day you'll get to take money out of your business and pay it to yourself, and then you'll use the Augusta rule to not pay taxes on it, blah blah blah. And it's just like, it's this fiction. It's this idea that if you just made it complicated enough, something something free money, and like that just isn't real. But we're just so tempted to believe that story because there's a financial incentive to believe that story. If you tell me if I just do A, B, and C, I will not have to pay taxes, I'm super on board. The problem is the tax code has contemplated this, right? The IRS has several billion use cases in tax returns and tax filings and tax cases and so on at this point. And so most of the stuff people talk about, like having your child be a model as a picture on your website and then paying them, $7,000 they can fund a Roth, like the IRS has been there, done that, seen that story, and also has given the review, and the review is that it stinks. Right? And so there's just a balance here where at the end of the day, people are really tempted to believe a fun story about saving money on taxes. And, the story's great, but it's just not true.
It's unfortunate to hear. Unfortunate to hear. You mentioned the Augusta rule. I believe it's the week of the Masters, at least at the time of this recording. Let me try to understand it. Right, I get to essentially rent my house out for 14 days, and I don't have to pay taxes on it. Is that the rule? I saw it was in the book. It seems like a secret of the rich. What am I missing here?
I mean, you're pretty much summing it up here. The trick here, and just for anybody's context, right? This rule exists because a congressman from Augusta's in Georgia, isn't it? Yeah, a congressman from the great state of Georgia went to Congress and said, "Wouldn't it be nice if all my rich friends who lived on this golf course didn't have to pay taxes on renting their house out during the Masters?" And they passed it. Kudos to them. However, there's a whole bunch of rules about personal use, business use, reasonableness, and so on. And so a lot of people just like to torture this into something. If you rent your house out, you don't have to pay taxes. And you'll hear it stretched through trusts, through business entities, etc. Keep it simple, stupid. Here in Colorado, for example, we're going to have Sundance coming to Boulder here in the next year. There's a world here where people in Boulder are going to rent their houses out for a week or two during Sundance and not pay taxes on it. Cool. But this idea that you can somehow like chop that up and play with it and turn your house into like a free income source, that part's not going to work.
Mm-hmm. So we're like, this is one of those that I hear about a lot, and I know the concept, and I was oversimplifying it on purpose, but I've actually never seen it done. Like in your experience, have you seen people like utilize this before? Because in my experience, people have a rental, they rent it out for a period of time, or they don't have a rental, and they don't get rental income. I've rarely seen somebody manipulate or try to actually just take advantage of the 2 weeks for income purposes and justify it.
I've seen it more applied as a de minimis exception than an actual money making strategy. So, like a good example is, for example, something like house swapping. There are websites out there and programs out there where you can sign up essentially to trade places with somebody. Maybe they're in Germany. You've got a nice place here in Colorado. You want to spend a month or two in Germany. They want to spend a month or two in the U.S. Great. We'll catch a flight to Dusseldorf and they'll catch a flight to Denver and we'll trade places. Well, technically, if there's a difference in the value of your homes, then the use, there's a barter element. And technically, if your house is worth, let's say, $1,000 a night on the open market because it's this beautiful Boulder mansion, and their house is a tiny apartment in Berlin, technically speaking, then there's an exchange of value happening here that could be subject to taxes. What I see in practice is a lot of people are inadvertently or unintentionally applying something like the Augusta rule to just sort of wash out some of the ramifications of that. Most people are also just doing it out of ignorance. They don't know that that's potentially taxable income or value to them. Same thing with barter elements, like I'll give you a bicycle for a birthday party. Like, I don't know, these weird exchanges people come up with where because no cash changes hands, they just think it doesn't apply. But the IRS is perfectly happy to tax you based on income, whether it is through in-kind services, whether it is through cash, whether it is through goods, right? If I pay you a chicken for something, you owe income tax on that chicken.
All right, and then the last one I wanted to touch on is real estate adjacent to its 1031 exchanges, right? So essentially, I have a rental property. When I sell it, I owe this money for the appreciation, but instead of selling it, I exchange it for a similar property, and then I get to defer the taxes, right?
I mean, you get to defer the taxes potentially, but there's still elements of the value of the exchange and whether it's equivalent value or greater or lesser values. There can be some taxes that come out of it anyway. This is one of those areas where, like, as a financial planner, I like 1031 exchanges because they save my clients money. And on principle, I dislike 1031 exchanges because it seems kind of shisty that there's just special exchange rules. Like, okay, can I have special exchange rules for stock? No, of course I can't. I've got to say when I sell it, pay taxes. But for some reason, we've created these magical carve outs to swap houses or swap tractors or various things like that. But you summed it up pretty well, right? If I engage in a structured transaction appropriately using the correct intermediaries and the correct reporting and so on, there's a world where I can sell a property and not incur capital gains in the short term and defer them out into the future, so long as I'm just sort of rolling the value into another property of like type.
Well, it's another one of those that I just don't see all that often because I know you can simplify the concept, but in practice they're actually kind of complicated, right? Because one, you need to find a property that's similar to the one you have. There's a time constraint on the amount of time, right? And then you actually have to somehow facilitate that exchange. Is it more difficult in reality?
I think it depends on whether you're prepared or not. I think it's easy to do if you already had like your replacement property in mind, your replacement asset in mind, or maybe you and a friend are going to do a 1031 pertaining to like a car exchange or something like that. Like if you've got your assets in mind already, I don't actually think it's that hard or that complicated. Again, you just need the appropriate intermediaries to make sure that all the record keeping stuff is done appropriately. I think the place where people get themselves in trouble is they just go like, oh, I'll do a 1031 and yeah, I know I've got, months and months to kind of solve this. So I'll figure it out when I get there. And then they do it and the taxes are deferred and that's great, but the clock is ticking. And some people do not take that ticking clock very seriously. So I think it's easy when you've got the outcome in mind. I think it's a lot harder when you're just sort of Hail Marrying into a 1031 and then hoping that you figure it out before the clock comes due.
All right, cool. Well, I'm sensing a theme here. For anybody interested in the book, is there anything else you wanted to add? Maybe that we didn't touch on. I know there's, as you said, I think 50 chapters, so definitely more than we touched on here today. But those were the ones that either felt fitting because of the masters coming up, or just interested. I was interested in, I think.
Well, and I think the abiding theme of the book is this, right? There are a lot of ways to make money. There's a lot of ways to build wealth. But at the end of the day, there is no magic wand for this. Some people get incredibly lucky, right? They're in the right place at the right time. They get the right job. They have the right family member. The right opportunity comes along. But for the vast majority of people, we're going to use consistent, reliable, well-known tools to build wealth. And it's going to work out just fine for us. We should be always skeptical when somebody tells us that they have some secret or that there's something that some family from 150 years ago knew back then that you could still use today to somehow beat the system. The system is a lot bigger than you. It's a lot bigger than me. I think you are always going to be a lot better off learning the rules of the game and playing it well than trying to break the rules.
Well said.
Well, Daniel, not to turn around on you too much here, but just because we're talking about the book, which I don't think we've even named this entire time, actually. So for anybody who has not caught on yet, the book is called Secrets of the Rich, What the Wealthy Don't Want You to Know About Money. But other than the title of the book, Daniel, what have you learned in the last 2 weeks that you think is valuable for our audience to hear about?
Well, I think like on that point, like I think in general, finance or not, we live in a very distracted society, right? It's very easy to, you know, get distracted, right? There's never been more things pulling for our attention, and it's never been easier to deviate from the thing you're doing and have that attention pulled elsewhere. And companies and people all over the world, make things really easy in terms of getting distracted, and whether that's finance related or not, right? But even going back to some of the topics we talked about today, like there are a lot of ways to get distracted when you're on the path to building wealth, or maybe you already have it and the game is no longer continue to accrue it and it's more protect what you have. Either way, it's really easy to get distracted. And I have a bias here because we do this for a living, but I tend to find people that I've kind of found out don't work with planners or don't have somebody in their ear speaking to them consistently tend to get more distracted, or have thoughts about some of these distractions more than people who realize, look, I have a plan, I have a path, and there's certain things that are going to help me get there. But the reality is all these signs along the road that I can read, I'm going to choose not to, or I'll read it and just continue driving, as opposed to stopping and reading and then asking the guy at the kiosk what the deal with this distraction is. I think if you have somebody as a professional kind of helping you navigate that path, it becomes a lot easier to avoid the distractions. Not to say they still won't come up and you still won't be curious about some of them, but like they're not going away. And if anything, they're just going to be easier to grab at your attention. And I think it's just important to be mindful of that in finance, but also just like pretty much everything in general.
Sure. I mean, I'll even throw this challenge out to everybody here who listened to the podcast last week. I think I recall saying on that podcast, if you don't have an estate plan, go get an estate plan. And what I'll throw out there is the challenge to anybody listening right now is if you don't have an estate plan and in the last week you didn't take some steps to go get an estate plan, that's a pretty good example of this.
Leave them alone, Dan.
Never. We're all going to die, Daniel. We're all going to die.
All right. Good speaking with you.
Always a pleasure. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.